Okay, potentially another big volatile week ahead. Um, Looks like Halloween came early, given what happened on Friday, Thursday. Um, Thursday, not so much. Thursday was a risk rally, bizarrely, following the US CPI data. We had the Bank of Japan that was speculated to have intervened very shortly after the US data was released, sending the yen much higher, the dollar lower. There were no sellers left in the stock market, apparently. That was the narrative anyway. And we saw a short squeeze very shortly after the data, but that was all reversed on Friday. So we had a bloodbath on Wall Street, which was good for the US dollar. US yields, not so good for the price of gold. So anyway, so this will be the first of a of a couple of pre-market analysis for the week ahead. We'll take a look at the article I've just published here at FX Street. I'm a senior analyst there, so if you want to keep up to date with my articles, you can go there. I publish between US and Tokyo hours in the news channel. Um, so I'll be doing some stuff there today when the market's open in Asia. But on a weekly basis, and I say this one in particular, this will give you a really good foundation for the week ahead and what to expect. I do a pretty comprehensive article in the analysis section titled Chart of the Week, and it's specifically relating back to gold, the gold price. But here I'll talk about stock markets, the price of the dollar and US yield. So we'll just do a quick sort of rendition of this article I've just published. With gold back under pressure, and there could be more downside to come, given the status quo and the US dollar pressing on towards, if you pull up your monthly charts, the 2002 levels. So yeah, it was a pretty poor end to the week on Wall Street on Friday. You had a sea of blood there with Tesla down around about 8%. Um, and you've got individual investor optimism over the short-term direction of the US stock market, recording one of its 60 lowest readings in history. So much of the same really to be expected of Wall Street for the week ahead, um, and which are all benefiting the US dollar and yields and weighing on the price of gold. We had, I talk about here the dollar milkshake theory, which is something you can look up if you go over to YouTube, check out the Real Vision Finance explanation of what it is. It's there on YouTube titled The Dollar Milkshake Theory Explained. It's pretty interesting stuff. Certainly helped me on my journey on analysis throughout the last couple of years. Dollar milkshake theory, or another way of putting it, is the dollar smile theory. Um, anyway, so look that up. So we talked about US yields. Now, they've carved out this W formation, which is a bearish inversion pattern, but considering it's holding at the neckline, it's completed a decent correction of that bullish impulse and subsequently has started to continue moving higher. So I've drawn out the projections, 100% projections from that range, which takes us right up to about 4.5% on the 10-year yield and brings us into the 2000 and 2008 financial crisis levels. So you can pull that up for yourself on the article if you want to go there and check it out. But there it is zoomed in. Um, and that in turn would be expected to pull the dollar higher, which is already embarking on the 2002 April May area. And then you've got the year 2001 levels higher up. You've got this W formation, which is completed at the neckline and subsequently started to move higher from that neckline support in a 38.2% Fibonacci retracement. So that's a support area, and those are the projected targets for the week ahead. And then that in turn, which would be fundamentally supported potentially if investors pick up on the highly hawkish, which is to be expected of this particular official, James Bullard, speaking on Saturday. And he was saying that the US dollar, yes, has moved higher, but he's basically essentially said that the Fed are not done yet, and the dollar will only start to come off once the committee thinks we're putting meaningful downward pressure on inflation, so rates don't need to continue rising. But as you can see here on the 10-year, we've already got those bullish expectations. We've got the Fed that are on a path of continuously hiking rates. The US inflation report has sent has basically put the money markets pricing in much higher rates for longer. So yeah, that's all there for plain for the eye to see. And then that would in turn see the dollar higher and put pressures on gold. And gold is on a weekly downtrend. It's broken the weekly structure. It's completed this this M formation. So the weekly structure there is around about 1670. So while below there we're bearish, and we're bearish down all the way into a measured move in towards the 1500 level. You can pull that up on the article and have a good read of that. And then on the daily chart, I'm not writing off a move higher initially. We could get a correction into the broader trend line towards last week's highs. We do have some price imbalances higher up, but again, while we're below 1700 or 1660 here, it's pulling up the prior week's low. We would remain bearish, but if it breaks this neckline of this M formation, then indeed we could see a bit of a push higher. Not writing that off by any means. And that's that scenario zoomed in. Now, if we were to stick with the bearish bias, then again, you've got this M formation. We could indeed either see a continuation, and that would be my preferred or my most expected outcome for a move lower. But if we were to see a pullback, we could have a correction, say a 38.2% correction or a 50% mean reversion, perhaps a touch higher to move into this price imbalance a little bit higher up, 61.8. Testing around the prior week's lows, not last week's, but I'm talking about the week before. We could have that correction into there and a move lower. And then on the 4-hour chart, same scenario really. You've got this M formation, a pullback, and a continuation lower, or we could just see this melt below last week's low, Friday's low. And then in terms of what have we got for the week ahead, we have the Bank of Canada survey, Fed speakers as usual. UK CPI is going to be a big one, and we had the Governor Bailey speaking over the weekend advocating for even higher than expected rate hikes. So that could put a bid into sterling initially. That could potentially weigh on the price of the dollar, given that other central banks are looking to catch up, including the ECB. And then you've got the New Zealand CPI inflation coming out as well, which will be important. So I'll talk more about the currencies. That was from TD Securities bank report that I received at FX Street. So those are the things to look out for. And as I said, this is basically a pre-market analysis for the dollar, yields, and gold. So just to recap, we're bullish essentially on the dollar, yields, bearish on gold. And then when we go across to the currencies, I'll do another video on the currencies, and I'll be taking into account the weekly template. I'll be using Stacey Burke's strategy, which this channel is essentially all about for the meantime. We're putting that to the test over these next few months. trading on a demo facility, picking up the nuggets in his methodology as we go along, improving um, on that day by day. So we ended pretty well on Friday with using that strategy, using the highs and lows of the day, the week, the weekly template, the flow of money, the stop hunts, the timings of when to trade and when not to trade. More importantly, the candlestick formations, bullish or bearish, and leaning a little bit against the sentiment in the market. So that's where we're at with this week's report, and I will move across to the currency shortly on my lunch break, and I'll send that out to be coming soon.